the Tulip Mania.
Tulip Mania, also known as the Dutch tulip bulb market bubble, was one of the most famous market bubbles and crashes of all time. It occurred in Holland during the early to mid 1600s when speculation drove the value of tulip bulbs to extremes. At the height of the market, the rarest tulip bulbs traded for as much as 6 times the average person's annual salary. Tulips were imported from Turkey, first arriving in Western Europe in the late 1500s. It looked like no other flower native to the continent, and they were commanded the same exoticism that spices and oriental rugs did. It is no surprise then that tulips became a luxury status symbol for the gardens of the affluent. Following the affluent, the merchant middle classes of Dutch society sought to emulate their wealthier neighbors and too demanded tulips. Initially, it was a status symbol purchased for the very reason that it was expensive. But at the same time, tulips were known to be notoriously fragile. In the early 1600s, professional cultivators of tulips began to refine techniques to grow and produce the flowers locally, establishing a flourishing business sector that has persisted to this day. In 1634, tulip mania swept through Holland. By 1636, the demand for the tulip trade was so large that regular marts for their sale were established on various Dutch stock exchanges. Everybody appeared to be making money simply by possessing some of these rare bulbs. Indeed, it seemed at the time that the price could only go up, that the passion for tulips would last forever. People began buying tulips with leverage, using margined derivatives contracts to buy more than they could afford. By the end of the year of 1637, as quickly as it rose, the confidence that drove the bubble quickly fell. Prices began to fall and never looked back. A large part of this rapid decline was driven by the fact that many people had purchased bulbs on credit, hoping to repay their loans when they sold their bulbs with the hefty return they expected in the future. But once prices started their decline, holders were forced to liquidate, to sell their bulbs at any time, and to declare bankruptcy in the process. Hundreds who had begun to doubt that there was such a thing as poverty in the land suddenly found themselves as the processors of a few bulbs, which nobody would buy, even at prices 1/4 of what they had paid. By 1638, tulip bulb prices had returned to their original worth of their true utility.
Now it is time to discuss the theories that could explain the reasoning behind the tulip mania. The first phenomena is glamour stocks. In the 1630s, tulips were still a novelty, a conversation piece, but mostly a representation of one's wealth. It was like the rich and the elite were almost socially obliged to own them. Tulips are not like shares from a company, but modern day equivalents of the tulips are, for example, products from Tesla, Apple, or Google. In the 1630s, tulips were a sexy product to own, but also to invest in. The second phenomenon that could explain the growth of tulip prices is momentum or positive correlation. When the surge of tulip prices began, no one in the time ever experienced such a booming market. Although we now know better, people in that time must have thought that what goes up tends to stick to go up. People began investing in tulips on credit. Normally they would never be able to afford these tulips, but they thought when they sold their tulips they would still have made a marginal profit because of the ongoing growth. The third phenomena adds up to the former phenomena, the greater fool theory. It is most likely that there were people that thought more rationally about the tulip prices. They knew the tulips were overvalued, but thought there is always a foolish individual that will purchase the tulips for an overvalued price. Therefore, they still decided to invest in tulips. Fourth phenomena is the representative error. People assume good companies or good industries are good investments. A couple of years before the spike in the prices of tulips, Dutch farmers were just able to better cultivate the tulips and grow and produce the flowers locally. People in the 1630s could have thought that this business sector was flourishing. Although this industry lasted until today, a good company or industry does not always mean a good investment. The last and fifth phenomena that could explain the surge in tulip prices is confirmation bias. Imagine the people were initially able to invest in tulips. This was a relatively small group of merchants and aristocrats. These were the rich and wealthy. These were the most influential people at that time. When these people invested in tulips and the prices started to grow, confirmation bias started coming into place, and people from the middle class also jumped onto the bandwagon. People buy in on what other people do, and if it compares what they already know and think, they also jump onto the bandwagon, especially when those other people are from higher descent. These decisions from this small wealthy group to invest in tulips and the growth in prices brought people from the much bigger middle class to this market, and this could have contributed to the exponential growth in price. Now the reasoning and theories of why the bubble burst will be discussed. The first phenomenon in this part is the reversal phenomenon. The premise of the reversal phenomenon is winners become losers and losers become winners. People with high hopes start cherry picking, and in this case and era, those cherries were tulips. Although if we look at the premise that winners become losers, oftentimes People who invested in winners get disappointed over time, and this is counterproductive in a booming market. The second phenomenon adds up to glamour stocks, the expectational error hypothesis. When people look at glamour stocks or good performing investments, in this case tulips, people could have extrapolated past growth rates too far into the future. When growth does not continue at the same rate it has in the past, investors can get disappointed and maybe even distrustful in the market. The last theory is the premise that things get in and out of fashion. Things are just in fashion. People stick to something for a short period and it will eventually get out of fashion and will lose interest overall. According to the hype around tulips in that era, it made perfect sense that not only the bubble burst, but it never regained momentum or growth.